As a property investor, I know I'm about to be hit by additional taxes here in New Zealand. But are there any ways that I can respond to those changes from the government? Hi, I'm Ed McKnight, economist here at Opes Partners, and in today's video, we're going to talk about the 5 things you can do as a property investor here in New Zealand to respond to the government's high taxes for property investors. And we call these the 5 R's. The first of which is to review your property portfolio. And the reason we say this is that not every property investor is going to be impacted equally by these tax changes. Let me give you an example. Here I've got the same property, a $900,000 property in Auckland, probably a townhouse, and I've run 2 separate cash flows for the next 15 years. So these are 15-year projections. On the left, we've got a situation where the property has 50% lending. So quite a low level of lending. Now this could be because the property's been purchased with a large cash deposit. It could also be if the investor had purchased it maybe a decade ago when properties were not as expensive as they are today, and so they've built up equity within that property. On the right hand side, we've got the same property, the same assumptions behind it, but with 100% lending, no cash deposit. And you can see that a difference in mortgage will massively impact how the cash flow works for these properties once the tax changes come in. In fact, it is a massive $241,500 difference over the long term, over those 15 years. So the first thing to do is to review your property portfolio, because you may not need to do anything additional in order to respond to these tax changes if you're happy with how the cash flow is. So if you want to run the numbers at home, you can do this by downloading the Opes Partners ROI calculator or spreadsheet. This will create those 15-year projections for you so you can see, well, where am I going to be, or where am I projected to be in 15 years' time? You can download that at opespartners.co.nz/ROI. Now, after you've done that, come along to the second R, which is to rent. Now, one thing that we've seen a lot in the media is a lot of property investors saying, well, if I'm being hit with significantly higher taxes, I have to pass some of those costs on in the form of increased rent. Well, since these tax changes were announced only 6 months ago, rents here in New Zealand have gone up $20 a week, from $530 to $550 a week, which is about $1,000 a year, a 3.8% increase in just 6 months. And something you're probably considering as an investor is, well, how much would my rent need to increase to fully absorb the effect of the increased tax for me? The answer is between 25 to 35%, depending on your operating costs, but let's call it 30% for now. Well, if rents were increased by 15% at a market level over the next 4 years, then 50% of the increased tax will be passed on to tenants. Of course, if rents increase by 30% over the next 4 years, then we'll see all of the incidence of the tax, or all of the burden of the tax, passed on to tenants as well. And in fact, in some areas of New Zealand, we are already starting to see those rents increase extraordinarily quickly. Over the last 12 months, August 2020 to 2021, Taranaki rents increased by 19%. In Canterbury, it was almost 11.5%, and at a national level, it was just shy of 8%. So one thing you're going to be considering as a property investor is, can I increase my rent, and by how much, once you come up to your rent review, bearing in mind you can only increase rent once every 12 months. Now, if you're saying, but Ed, I don't really want to increase my rents on my tenants, I really like them. Well, one thing you might also like to consider is moving your property from the private housing market across to the public housing market. And what I mean by that is renting your property out via state housing, or renting out with a registered community housing provider, because there are tax incentives to do so. You're not going to be impacted by these increased taxes if you rent out via social housing. And if you want to learn more about that, check out video number 4 in the 6-part series, because we deep dive into it. If after increasing your rent, you're still not where you want to be, check out R number 3, which is to restructure. And what I specifically mean about this is to restructure the ownership of your properties in order to be able to decrease your tax rate. Let me give you an example of what I mean by this. Let's say you're a very high income earner. You earn over $180K a year in your salary. Well, your tax rate for any profits, or any taxable profits on your investment properties, are going to be taxed at 39% if you own it in your own name. Well, one thing you could do is restructure that property under the rollover relief provisions and put it in a trust. well, your tax rate is going to go down from 39% to 33%, and you'll save 6 cents of every dollar. Now, if you are going to restructure your property portfolio in order to decrease your tax rate, you need to talk to a professional property tax accountant. And the reason for that is twofold. One, you want to make sure that you are minimizing your tax as much as possible. But number two, you don't want to be running foul of any of the IRD's rules or guidelines. That's going to be a bad time. And if you want to deep dive into some scenarios of where restructuring your portfolio might work, check out video number 3 in this series where we went through a couple of different examples. So at this point, you've reviewed your property portfolio, you've thought about increasing rent, potentially doing some restructuring. If you're still not where you want to be, come down to our number 4, which is to renovate. And what we mean is specifically targeting your renovation investment in order to increase the cash flow of your property. You're going to increase its value and increase its perception, or improve the perception for tenants such that they're willing to pay you more for it. And one tactic we often use in this process is to add an additional bedroom within the current internal floor plan. Let me show you what I mean. Here's an example of a floor plan of a real property in Hamilton that one of our investors had purchased and renovated. Let me ask you, where do you think they put the extra bedroom? If you said in the kitchen, you are correct. So what they did is they took out some of the internal walls and they built another one. And they turned the kitchen into a bedroom. Now you're probably wondering, well, where did the tenants cook then? Well, what they did is they turned the old lounge dining area into a kitchen / lounge / dining, kind of open plan, more modern structure for those tenants. And so the benefit was a renovated kitchen, a new bedroom or extra bedroom in the property, and the rent significantly increased. But if you're unable to do that, check out some of the other tips or tactics that we use within our 6-step cash flow hacking process here at Opes. So of course, the first one is to add an additional bedroom within the current internal floor plan. But you can also assess your rental options. Now, what do I mean by this? Well, could you renovate the property to turn it into a room-by-room rental? So could you rent it out room by room to students? Could you turn it into 2 separate dwellings? Could it be a home and income? Any time that you're able to renovate a property such that it can become a multi-income property, then it will significantly increase the yield in general terms. Next step after that is to look at the kitchen and bathroom, because this is where you can relatively economically improve the value and really make it much more attractive to tenants. After that, think about upgrading the fitting. So what do I mean by those? Doorknobs, cupboard doors, cupboard handles, light switches, light fittings, all of the aesthetic stuff. Because if those aren't looked after, it can really date a property and decrease the value perception in tenants' minds. Next, you want to be thinking about a paint refresh, specifically in the internal walls rather than the external walls. That's where you'll get most bang for your buck. So can you do a wee paint job? And then let's refresh the carpet. Now that doesn't necessarily mean replacing the carpet, but it could mean getting out the rug doctor to really give it a good clean and bring it back to life. These are the 6 tactics that we've found tend to most economically increase the rent so that you're not going to be as impacted by those extra tax changes. And lastly, if none of these tactics are getting you where you want to be, it's time to think about recycling. And what do I mean by that? Recycling your equity. So potentially selling the property you've currently got and moving that equity into a more tax-friendly asset. Let me give you an example of what I mean. Let's say you currently own a $1.05 million property somewhere in Auckland, maybe Wellington. And let's say there's a $600K mortgage on there. Well, before you recycle that equity, of course, you've got to sell the property, so we need to account for sale costs. Here at Opes, we usually say 5% of the property's value should be allocated for sale costs. So I'm going to account for 50 grand here. Where's that going to go? To your real estate agent. It's going to pay any marketing fees to market the property, your auctioneer, maybe some lawyer fees, bank discharge fees, all of those sorts of things that you want to account for. That gives us $400K worth of cash to play with. Well, one thing you could do in this scenario is to purchase 2 new builds as long as you can get the servicing for the mortgages. And that's because a new build only requires a 20% deposit in order to purchase. And of course, those new builds have a 20-year exemption from the tax changes, so are significantly more tax friendly. So what have we changed up here? Well, we've gone from one property or one portfolio worth just over $1 million with a property that is soon to potentially be not very tax friendly, And we've moved that equity across so that we've almost doubled the size of the invested assets within the portfolio, and those assets are significantly more tax friendly. So this is one option you can think about. But just before you go out and sell all your existing properties, purchase a whole heap of new builds, just make sure that it does start with the review process. You want to review your portfolio. Where are you going to be and where are your properties going to be? Make sure you do download that spreadsheet at opespartners.co.nz/ROI to see where your properties are going to be. And of course, if you want to learn more about property investment, make sure you tune in to the Property Academy podcast, because every single day we release a brand new episode to teach you something new about investing in property right here in New Zealand. You can find that on Apple Podcasts, Spotify, or your favorite podcast listening app.